At the end of September, interest rates went up pretty much across the board. 5-year fixed rates went up, variable rates went up. It was pretty much every type of mortgage that you could get in Canada went up in price. And then something happened in the worldwide economy that might cause interest rates to come back down. So in this video, we're going to discuss what the full featured rates are right now, what the discounted mortgage rates are, and at the very end, I'm going to talk about that thing that happened that may give us some relief from rising interest rates. But before we get into all the details, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And by the way, if you're looking at getting into the mortgage market, we have a course called Secrets to Getting the Lowest Interest Rate that will teach you everything about how to get the lowest interest rate, including how to negotiate with your bank, how to negotiate with your broker, what's negotiable, and how to get the absolute best price on the best mortgage, including all the landmines and surprises that you should be avoiding. If you want to sign up for that course, go to ratesecrets.ca and we'll see you in the program. Okay, so let's get into it. Let's discuss what's going on with interest rates for the month of October of 2022. Now, at the end of the month, pretty much every lender in Canada increased their interest rates because 5-year bond yields went up substantially. But just as those interest rates went up, the British government announced some tax cuts, which led to a sell-off in bonds that left many people very worried about the UK economy and the status of many of the pension funds there. Because what happened is many of the pension funds had large holdings in bonds that were leveraged. And because of the sell-off, it forced many of those pension funds to have to raise capital and potentially almost collapsed a bunch of them. So the Bank of England stepped in, they started buying bonds, and lo and behold, interest rates started to reverse. And I'm going to show you that at the very end of this video, what happened in the Canadian market with respect to interest rates as a result, and why we could be getting a little bit of a reprieve from the interest rates that went up at the end of September. Okay, so let's get into the interest rates. And what you'll notice is we have a little bit of a new format here. We're going to give you a little bit more information, but we're still going to try to keep it as simple as possible. So we're going to start by talking about 5-year full featured mortgages. So these are the mortgages that have all the bells and whistles. They have full prepayment privileges. They have lower penalties if you're getting them from lenders like First National and MCAP, and they don't come with any restrictions. So in other words, if you decide you want to leave and you want to pay the penalty, you can go to a different lender or you can refinance, you can do whatever you want, because they don't come with things like bona fide sale clauses and other restrictions that come on the discount mortgages. So let's start first and foremost with insured 5-year fixed. These are now up to 4.84. In the middle of September, we were getting these mortgages for around 4.59%. With higher bond yields in the middle of September, these rates started to come up, and pretty much every lender in the country increased these interest rates almost overnight, right before all the issues in the UK happened. Now, if you're putting 20% down, remember that 20% down payment is the riskiest mortgage for the lenders because they don't have mortgage insurance, and it is the most exposure that those lenders are going to face. So these ones are priced a little bit higher than pretty much anything else. So with 20% down payment, you're looking at 5.04 on a full featured mortgage. With 25% down payment, you get a little bit better price, 4.99%. If you get 30% down payment, you don't get much of a break by going from 25 to 30% down payment. But when you get to 35% down payment, you start getting back into rates that are comparable to the insured mortgage rate. So back to 4.84% if you're putting greater than 35% down and purchasing for less than $1 million. Now, if you're buying over $1 million, if you want a 30-year amortization, if you're refinancing, these are what's called uninsurable mortgages. So not only can you not get insurance against them, but the lenders can't buy portfolio insurance, which makes these substantially more expensive. So if you're looking at that $1 million plus 30-year amortizations or refinance, you're basically looking at 5.34% right now for your rate. Now, moving into 5-year variable rates, these are again the full featured ones. These ones come with just a 3-month interest penalty. So in my mind, these are the most flexible mortgages you can get because you can get out of them, you can refinance to a lower interest rate. They're really, really, really the best product in my mind and have been. The one caveat to this, because everybody went out, got a variable rate mortgage with their big bank, didn't realize it was different than a variable rate mortgage with Scotiabank or with First National or MCAP, is you want to make sure that if you're getting a variable rate mortgage, you're getting one with adjustable payments so that as interest rates change, so too does your payment, and you're feeling the changes gradually rather than all at once at the end of 5 years when your mortgage comes up for renewal or when you hit that trigger rate. So let's take a look at these rates. Insured, you can get at prime minus 0.9%. So that is 4.55% because the prime rate is 5.45%. If you're putting 20% down, you're looking at prime minus 0.55. So in other words, 4.9%. At 25%, you aren't getting a break. Notice that this is different than the fixed rate mortgages. At 30% down, however, you start to get a pretty big break on the interest rates. And again, once you get to greater than 35% down, you're at prime minus 0.9, which is the same rate that you would be paying if your mortgage was insured. Now, here's where it gets interesting. Uninsurable, refinance, $1 million plus, 30-year amortization, you're looking at prime minus 0.4, which is not as competitive as most of the other rates. Now, that being said, you'd still be at 5.05%. That, by the way, is pretty close to the interest rates that my wife and I pay for our mortgages. We know that the products that we're getting are the best products. We're willing to pay a little bit more for them, especially given that we have lots of flexibility. So that's the type of mortgage that we have. It just happens to be that two mortgage brokers who can get pretty much access to anything pay a little bit more for a little bit better product because we understand the differences. Now, moving into discount mortgages. These are the mortgages that come with restrictions. So you may not be able to switch to a different lender. You may not be able to port the mortgage to a different property if you decide that you want to move. You may have reduced prepayment privileges, or you may have higher penalties. It really depends on the lender and the product. But discount mortgages, if you're paying the absolute lowest rates that you can find in Canada, you absolutely get what you pay for, and it comes with some restrictions. Typically, the restrictions are things that you probably aren't going to realize are there until 3 to 5 years later when you realize that they've come back to haunt you in some way, shape, or form. So we caution you against these. And if you are getting a discount mortgage, make sure you totally understand what you're getting and do your due diligence. Just don't take some salesperson's word for it who says, this is a perfectly fine mortgage. Don't worry about it. You won't have to worry about refinancing to a different lender. You won't have to worry about porting your mortgage because you don't plan on moving at some point in the near future. Well, these are the things that are unexpected, and it's the unexpected things that hurt you in the mortgage world. So insured mortgages that are 5-year fixed discount mortgages are going for 4.64%, so about 0.2% lower than their full featured counterparts. If you're putting 20% down, you're looking at 4.84%. 25% down, you're looking at 4.79%. Similar to the full featured mortgages, you don't get a break once you get to 30% down payment, but you do once you get to greater than 35%. So that rate being 4.64%. And then last but not least, uninsurable refinance, 1 million plus. There's really no point in getting a discount mortgage if you are getting an uninsurable mortgage. You pretty much should stick to the full feature if you are in that boat. Moving on to the 5-year variable discount mortgages, these are where the interest rates get really, really good. But again, we caution you against taking the discount mortgages. If you're looking at insured, you're looking at prime minus 1.15. So you're basically looking at 4.3%. At 20% down, you're looking at prime minus 0.8. 25% down, you're looking at the same rate. At 30% down, you're looking at prime minus 1. And then you get that big jump again when you get to greater than 35% down payment. And again, the uninsurable refinance discount rates just aren't super competitive right now. So definitely the interest rates have gone up pretty much across the board when it comes to mortgage rates in Canada. Again, we had that big jump at the end of September, but with the UK cutting taxes, which is inflationary, by the way, and that led to a sell-off in bonds, which led to higher interest rates, which led to the value of bonds going down, because when interest rates go up, the value of bonds go down. And the Bank of England had to step in and save a whole bunch of pension funds in the UK. So what that meant is that they stepped in and they started buying bonds in a similar fashion to how they were buying bonds early on in the pandemic, just like every other central bank, in order to bring interest rates down. So the Bank of England actually stepped in and tried to decrease interest rates in the bond market, which led to bond prices all over the world to go up, including in Canada, which meant that right after interest rates went up on our 5-year fixed mortgages, bond prices started to increase, which led to interest rates going down, at least on the bond yields. Now, that hasn't translated through to mortgages yet, but it very well could in the coming month here. So if you take a look at what's going on with the Canada 5-year government bond, this was what was happening. This on September 27th is where interest rates in Canada for mortgages went up across the board. But then the very next day, when the Bank of England stepped in and started buying bonds, which led to lower interest rates in England and subsequently led to lower interest rates all over the world, we saw this pretty big drop of 25 basis points, 0.25% in a day. Now, this hasn't been translated to interest rates, mortgage rates as of yet, but my guess is if these government bond yields remain low for the next week or two, we are going to see some downward pressure on 5-year fixed rates, which means that if you're thinking about locking in, you've probably got some options with respect to interest rates going down in the coming weeks. And it also means that if you're looking for a 5-year fixed mortgage, there's probably going to be some opportunities to get a better rate in the next week or two. So if you're a month month out or 2 months out from taking possession of a property, you're going to want to be paying attention to what's going on with interest rates. So really interesting things happening in the worldwide economy that are obviously trickling down to Canada and will trickle down to our mortgage rates here. It's going to be an interesting month. We'll see what happens in the next little while. But basically the message here is that we're not out of the woods yet. And even with high inflation in the UK, they had to step in to make sure that bond yields didn't go too high, which if similar things happen in North America here, we could end up seeing downward pressure on bond yields. Now, this isn't to say that mortgage rates are going to go down. That's not what I'm saying. I'm not making a forecast here. I'm simply conveying what happened in September and into October with interest rates and how that could play out with respect to 5-year fixed and 5-year variable rates in Canada. So hopefully you found this video useful. If you did, hit that subscribe button. And if you want to get hooked up with the Secrets to Getting the Lowest Interest Rate course, don't forget to go to ratesecrets.ca. Oh, and if you want to know a little bit more about what's happening in the Canadian real estate world, go ahead and check out this video right here.